The reason I don't believe we can have a crash is what we talked about.
Right.
You're going to nuke the entire pension system, the banking system, and the economy, because there's too much debt. So we debase the currency, i.e. it will not be allowed. And I know people might not like that, but it is what it is. We've got 6 years before 2030, 2032, when the economic system starts becoming not understandable to us, because we don't need humans. We find different purposes, different ways of doing stuff. I'm not negative on humanity, like we're all going to be displaced. But there's going to be such big shifts in what an economy is. When a robot's paying an AI, and there's no humans involved, what is that? That I think we've got 6 years before that happens. So I think we've got 2 cycles of the everything code to make as much money as possible to not have to worry about what happens. I take it very seriously, the 6 years and these cycles. I'm not a believer in trading the cycle. I'm a believer in, when we have the big drawdowns, I look forward to them because you can add as much as possible and compound because you don't have much time. And if you mess it up and you're out of the cycle or whatever, this is the don't fuck this up thesis, you're going to miss this opportunity. Yeah. So yes, there is time pressure here. Get it right, and that leads us into the banana zone. The majority of this wealth happens in crypto or macro summer and fall. Fall is tricky because we don't know where the cycle peaks. But it's this point here around the US election and for about 12 months afterwards that things go bananas. And you see it every time on the Bitcoin's chart, it just does the same thing. So I know a lot of people dollar cost average. Great. This is not the time to dollar cost average. This is the last chance saloon before it gets crazy. That's when you need to have your money in the market fully.
Raoul Pal begins by addressing a critical concern: the potential for a massive economic crash. He argues that such a scenario is unlikely because it would devastate the pension system, the banking sector, and the broader economy due to the overwhelming amount of debt in the system. Instead of allowing this to happen, governments and central banks are more likely to debase the currency to manage the situation. This reality, Pal suggests, is something investors need to accept in order to effectively navigate the financial landscape. He emphasizes the importance of adapting to this environment rather than fighting against it. Pal argues that there is a limited window of opportunity, about 6 years, during which individuals can position themselves to benefit from these changes. He advises focusing on making as much money as possible during this period, particularly through investments in sectors that are likely to benefit from the technological revolution. However, he also warns against trying to trade cycles or time the market too precisely, as the risks of missing out on opportunities or making costly mistakes are high. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The reason I don't believe we can have a crash is what we talked about.
Right.
You're going to nuke the entire pension system, the banking system, and the economy because there's too much debt. So we debase the currency, i.e. it will not be allowed. And I know people might not like that, but it is what it is. Once you learn to accept something as it is, it's much easier to operate or invest around it, whatever. But then we've got the technological revolution that I call the exponential age. All of these technologies that are intertwined, going exponential at the same time, right? This is going to be a renaissance. We're going to change what humans do for their existence. We're going to change the very structure of economies, even money. We don't even know what money is going to mean in a world of abundance. We're so used to scarcity. Lawyer gets paid a lot of money because he has scarce knowledge. There's only X number of lawyers qualified. We know this scarcity thing because once you dealt with Bitcoin, you kind of understand the whole thing.
Yeah.
So they charge a premium because they're scarce. Gone. All gone. All knowledge premiums are gone because we're going to scale knowledge infinitely. It's like people don't understand certain things, like you see written down AI has an IQ of 100. Okay, well that's an average human being. It has an IQ of 100 on every single topic that all of humanity knows. It's a polymath. People don't think that.
Yeah.
And this is the dumbest the AI will ever be. I actually think AI is gaining consciousness or has consciousness. But that's a whole different topic for another day.
Yeah.
But so this decade, in fact, I don't even call it a decade. I think we've got 6 years. We've got 6 years before 2030, 2032, when the economic system starts becoming not understandable to us because we don't need humans. We find different purposes, different ways of doing stuff. I'm not negative on humanity, like we're all going to be displaced. But there's going to be such big shifts on what an economy is. When a robot's paying an AI, and there's no humans involved, what is that? That I think we've got 6 years before that happens. So I think we've got 2 cycles of the everything code to make as much money as possible to not have to worry about what happens. So if you go to 2032 and we're going to you start a great business. I see you, or my AI sees your business and says, hey, I can copy that and turn it into Hindi and sell it to India. It can do it in a minute. So how can we create products? How do we compete with each other when everything can be instantaneously replicated? Even with 3D printing as it comes in, it becomes even hardware manufacturing, everything. So I worry about what economic value is in stuff like that. So my view is we have 6 years, make as much money as possible.
So the base case
which is the other thing is you hear me talking about, which is how to unfuck your future.
Yeah.
And everybody knows they're screwed right now. They can't get up the ladder. That, like your kids, there's like how they're ever going to buy a house, right? So they're going to have to either be genius entrepreneurs and take huge amounts of risk with their entire thing, fine, but it may not suit them. Or they're going to have to make some investments that make up for that gap. There's no other way around it without being poorer than you were. I take it very seriously, the 6 years and these cycles. I'm not a believer in trading the cycle. I'm a believer in, when we have the big drawdowns, I look forward to them because you can add as much as possible and compound because you don't have much time. And if you mess it up and you're out of the cycle or whatever, this is the don't fuck this up thesis, you're going to miss this opportunity.
Yeah.
So yes, there is time pressure here. Get it right. And that leads us into the banana zone. The majority of this wealth happens in crypto or macro summer and fall. Fall is tricky because we don't know where the cycle peaks. But it's this point here around the US election and for about 12 months afterwards that things go bananas. And you see it every time on the Bitcoin's chart, it just does the same thing. So I know a lot of people dollar cost average. Great. This is not the time to dollar cost average. This is the last chance saloon before it gets crazy. That's when you need to have your money in the market fully. The other thing then is to not do stupid things when it starts going crazy. We've seen that in the past. People lose their minds. We just got to not lose your mind. Don't do stuff that gets greedy, use excess leverage. Don't do stuff with your wallet and compromise losing your Bitcoin. Don't do any of that stuff. Just sit, let it play out, and enjoy it, and don't try and time it too much.
One of the most intriguing aspects of Pal's analysis is his discussion of the cyclical nature of markets and economies. He points out that since the 2008 financial crisis, the global economic system has been operating on a more predictable 4-year cycle, largely driven by the debt refinancing needs of governments and the corresponding debasement of currency. This cycle, which is closely aligned with the US presidential election cycle and the Bitcoin halving cycle, has created a more structured environment in which asset prices, including those of cryptocurrencies, move in a more predictable pattern. Pal breaks this cycle down into 4 phases, which he likens to the seasons: winter, spring, summer, and fall. Each phase has distinct characteristics, with winter representing a period of economic contraction and asset price declines, and spring marking the beginning of a recovery. Summer is the period of rapid growth and expansion, driven by liquidity injections from governments and central banks, while fall is the peak of the cycle, where asset prices reach their highest levels before the next downturn.
What's weird is it makes everything so simple.
Too simple.
That most people think, well, this can't be possible.
Yeah.
We kind of knew it in Bitcoin world because we could see a cycle forming, and we've been following this cycle kind of dumbly, like, well, it's kind of maybe just the halving cycle, we don't really know. And then I started digging in and realized that the business cycle was perfect. So the business cycle, I used the ISM survey, and it was a perfect cycle. I'm like, that's weird, because if you remember, go back prior to 2008, we'd have these long periods of no recession, short periods, and it was variable. But suddenly it's like a metronome, as you say. I'm like, what's that all about? And eventually it led me to realize that 2008, I think, was the Great Reset. The one that people keep expecting happened. What they did is they basically they told everybody they could forego paying interest on all their debts, which was zero interest rates. And then they tried the new trick of printing money via quantitative easing. Now, what that did is allow every single major government in the world to refinance all of their debts on this 3 to 5 year sector. And so they all did it. And what it did was force the business cycle into this 4-year cycle. And then all the asset prices are all correlated. Whether it's tech, whether it's Bitcoin, whether it's the economy itself, it's all driven by the same cycle, which happens to be the presidential election cycle, which happens to be the Bitcoin halving cycle. It's all the same thing. And so when you understand that, it makes the game a lot easier. Now, this is not going to last forever, but for the period of time that we've got, it seems to be playing out perfectly. And you can break these cycles down to 4 phases, which I call the seasons. So we have, call it crypto or macro winter. Well, that was 2022. That was 2018. That was 2014. That is 4 years. The next part of that is spring, when nobody quite believes that something is changing, but prices start moving higher. You know, Bitcoin had a great year in 2023 against most people's expectations, because spring is the time the shoots come up. Then you start transitioning to summer, which is this year, which happens to be the election year, which is when really the debt starts getting refinanced and they have to start using liquidity to finance it, because there's not enough GDP growth to pay for the interest on the debts. And so they keep rolling forwards these debts and they keep monetizing the interest payments, which is this debasement of currency that happens at about, on a globalized level, 8% a year. They're debasing currency. And then next year will be macro fall, and then eventually the cycle tops out and we repeat it again because it's based on the debt refi cycle.
Right.
That this debasement of currency of 8%, there's 2 ways of looking at it. You can say, rightly so, we're being robbed of our future wealth because your future self is getting poorer because you can afford less assets with your income, because income doesn't go up, the assets do because of the debasement. Or the other way is you can say, I'm paying an 8% put option fee on the entire system not breaking, because that's also what they're doing, because they need to refinance the debt. They need to not let asset prices go too far down. So we can talk about that, but it's another way of looking at it. And you're like, would you pay 8% a year to have the entire system not break? Maybe. So you keep adding debt just to pay the interest payments on the old debt. Now, why is that phenomena there? It's pretty straightforward when you understand it. The US government and all the major Western governments, plus Japan, plus a few others, are about 100% plus of GDP in debt. Now, let's say, theoretically, interest rates are 3%. Well, if GDP growth is at 3%, then all GDP growth goes to pay those interest payments. Okay, but the problem is the private sector is over 100% of GDP in debt as well, and it's got interest payments. So if they both have it, there's not enough GDP to cover it. So what they've essentially done is removed the government debt payments out by printing money. And that stops the whole system becoming illiquid. Because if you think about it, you talked about collateral. Collateral is the money pledged against a loan. If the collateral falls too fast or too far, then you break the covenant on the loan and it gets called on you. And that's the whole system. That's what happened in 2008. So the best thing to do is not let the collateral fall by debasing the currency, and optically it goes up. So it kind of stops the system imploding.
Yeah.
Pal advises investors to take advantage of the opportunities presented by rising asset prices. while also preparing for the eventual transition to the fall phase. This involves being mindful of the risks associated with the end of the cycle, such as increased market volatility and the potential for a sharp correction. Raoul Pal's analysis offers a nuanced and forward-looking perspective on the future of the global economy. His insights into the interplay between technology, debt, and market cycles provide valuable guidance for investors seeking to navigate the challenges and opportunities of the coming years. By understanding these dynamics and positioning themselves accordingly, individuals can maximize their chances of financial success in an increasingly complex and rapidly changing world. Please like and subscribe my channel.